Hey everyone, in this video we're going to be walking through the LBO model that we've built out in the previous videos. And if you recall from those previous videos, in this hypothetical LBO acquisition of a company, this company put in $5.5 million and got out $2.2 million in 4 years. This equated to a 4 times money multiple or a 40% IRR, which is an amazing result for this particular company. And they were able to achieve this very impressive result because they used a lot of debt, which they paid down using the cash flow of this business, which reduced the amount of equity that they actually needed to put in initially, which of course boosted their overall return. But this of course came with its own risk. Number one, we were paying interest rates on this debt the whole time. So we had interest expense coming out and impacting our cash flow. And I just realized that we hadn't gone back to our initial interest expense in our P&L. So let's quickly fix that, which is actually going to reduce the amount of tax that we would have had to pay because this is going to reduce our overall profit before tax. So this is actually going to improve our multiple very, very slightly. So you can see our IRR has jumped very, very slightly. Anyway, so in this video, what we were going to do is, this result was based on the assumptions we put in our model. And obviously any model is only as good as the assumptions and the underlying data you're using. And the longer the forecast period, the more risk of getting it wrong is. So what we're going to do in this video is we're going to play with different assumptions and see what happens with the outputs. And that will give you an idea as to, what is really driving this return. So I guess first of all, let's play with the lever of debt. So, we talked about how debt is a significant driver of returns, but it's also correlated with risk. So what happens if we bump up the debt to the debt that we're going to be using to fund this acquisition to, instead of it being 3 times, and let's put in a little input cell that we can play around with. I guess we'll copy this one. So right now we're assuming 3 times EBITDA times that. What if we were to use no debt? Let's go down to 0. Let's see what happens. First of all, we just need to make sure our calculation is working. So let's just plug that the sum of this equals, we should be doing the sum of this minus that. There we go. So now this is working. So let's see what happens to our returns when we put no debt in the business initially. So you can see it's had a massive impact on our money multiple. Instead of it being, let's see, what was it, 3 times? We had 4 times money multiple originally at a 40% IRR. But with 0 debt, what actually happens is we obviously need to put in the entire amount of equity ourselves up front, which means this bar is bigger, which means that there's no debt to pay down, but there's less differential between the amount going in initially and the amount going up, which is why our money multiple is significantly lower and our IRR has also dropped. So you can see that's why private equity firms are so keen on using debt, and even venture capital firms as well. When they're putting debt in investments, it's less likely because there's other shareholders on the cap table, but there are instances where they might do that. And you can see why it's such a great driver of returns, because it does really correlate with your overall returns. Imagine if we put 6 times debt in, we were able to get a 7.8 money multiple. But obviously this is a huge amount of debt. It's a huge amount of risk associated with having $6 million debt in a business that's only generating $1 million of EBITDA a year. Or from cash flows, we're only generating, 90% of that, plus we got to pay tax, plus we got to pay capex. So in reality, we're only getting, roughly $600K a year in cash flow that we can use to pay down our debt, of which this is how much goes into interest rates. And the other thing that we need to consider is we're obviously in an environment where historically we've had very low interest rates. But in future, what might happen is those interest rates might actually go up quite substantially. So let's see what happens when we put our interest rates up to 8%. And keep in mind, this is not the cash rate, because obviously lenders who are going to lend you money take the cash rate plus their level of risk. And for an LBO deal, you can expect a very high rate of risk associated with that. So you're going to pay a very high premium on top of that. So we'll do some different videos later on about debt and the different products and what are the associated interest rates for each of those. But let's see what happens to our return now. 8% interest rate. That means that our interest paid each year is about $560,000, which is almost all of our free cash flow. So most banks wouldn't lend you this amount of money because your cash flow barely just covers it. So in reality, if we leave the interest rate there and we just reduce our bank debt down to 3 times, this is probably what you can typically expect for a mid-market private equity deal, which is kind of in the range of $1 million EBITDA. Okay, so that's debt. Why don't we also play with the initial acquisition multiple? And this is why it's so important to be really disciplined about acquisition multiples. Because ultimately, this is also a big driver of your turns. Like, what happens if we end up negotiating an extra multiple on our business that we need to pay? So you can see that the vendors will only sell to us for an 11 times return. It's going to have a big impact on our money multiple because obviously we're paying more money up front and the difference between what we can get at exit has suddenly been reduced. And what happens if we actually assume the same exit multiple that we do entry multiple at 12 times? That's actually going to have a big impact on our returns as well. So you can see it's gone from 4 all the way down to 3. And IRR has gone all the way down to 32%. But again, we're in a very unique macro environment where over the past 10 years, companies have benefited from decreasing interest rates and quantitative easing, aka printing money, which has resulted in a lot of cheap money flooding in for the same number of assets. So stocks, private assets, private businesses, venture capital investments. So what's actually happened is the multiple that people have been paying, they might have been kind of 6 times 10 years ago, but they've slowly been creeping up because people have got more money, therefore they're beating up competition. So a lot of private equity firms, investment banks, venture capital, etc., they've been able to assume significantly higher exit multiples. And they can assume some multiple arbitrage. But because the macro environment is actually changing, interest rates are going up, quantitative tightening is happening, so they're sucking out liquidity in the system. What might actually happen in future is we can't actually assume these very high exit multiples because if interest rates are going up, there's less cash in the system, people aren't able to pay as high or aren't willing as high, and there's as much capital to compete with. So, a more realistic assumption is we might actually assume a reduction in exit multiple. And that might end up meaning that we're actually paying a higher multiple than we are at exit. So it's not the end of the world because we're still getting a decent return to 2.7x. Remember, anything above 2.5x is going to put you in the top quartile of fund returns globally for an investment, or an IRR of just under 30%. So it's still a decent return, even though we're assuming very conservatively that we're paying more for the business upfront than we are at exit. So the key learning here is try and be as disciplined as possible around multiple. The funds that are going to do the best over the next 10 years are the ones that haven't been overly aggressive in paying up for deals, but instead have been able to leverage certain things to negotiate lower entry multiples. So for example, maybe you have an angle by being able to acquire another competitor and saying, well, we can actually, bolt on this group, which offers a lot of synergies. They've got a lot of strategic benefit. They're going to able to improve your product market fit, and be a lot more attractive at exit. And that might be your way in to actually doing this deal at a lower multiple. Or it could be maybe you're just good at negotiation, maybe it's starting high and chipping them down, although that's obviously going to cause conflict later on. However you do it, it's highly recommended that you stay disciplined in entry multiples because obviously if the worst case does happen and we can't get these higher exit multiples at exit, and let's say we end up only getting 6 times, we're still going to get an okay money multiple, and best case money multiples stay the same, then we're still going to get an amazing return. Now this is at 6.4x. So let's bring this up to 8 times. Okay, so our other levers are, potentially we could play with how much we're acquiring the business, right? But ultimately this is not necessarily going to reduce the proportionate return, but it is going to change how much you're getting in and how much you're getting out, because you're just essentially getting a smaller percentage of the same pool size. So for a lot of businesses where, looking forward, they're not seeing much benefit of multiple arbitrage, aka where multiples go up over time. So let's assume in both situations we're going to go in at 6 and we're going to exit at 6. That means companies these days, there's really 2 ways that they can really drive returns. The first is through the use of debt, so being more aggressive with debt. The second is driving organic growth, so being a bit more hands-on with the business. So whether that's cost cutting, so basically getting rid of costs to drive EBITDA, whether it's implementing strategic initiatives to drive revenue, or whether it's kind of arbitraging cost overseas, so using some offshoring, or maybe spending more on the short term for growth expense like marketing, etc., or new sales, BDM, which is going to drive higher revenue, and that's going to increase your EBITDA in the long run. And the final way that we could potentially do this is through bolt-on acquisitions. So bolt-on acquisitions is something that we haven't really modeled in here, that we probably should, but it adds a level of complexity to the model where the main benefit of bolt-on acquisitions is if you can buy additional businesses at a low multiple that you're buying the initial platform, you can actually average down your multiple. So this might mean if you're buying another acquisition at 4 times, your average acquisition multiple might be 5 times. So all of a sudden your money multiple has jumped. The other way that through bolt-on acquisitions can grow your business is through exit multiple. So typically what happens is businesses will, as they get bigger, the multiple they can attract scales proportionally. And this is simply because the larger the business, the stronger the market position is, the stronger the moat to competition. Obviously OPEX scales, it's relatively fixed, but revenue continues to grow. So therefore your margins are expected to grow at an ongoing rate. There's more ability and more capacity to invest in things. So maybe R&D for new products. Maybe it's, you've got the capacity to invest in things like, property maintenance. Maybe it's being able to invest in international expansion, which all of these things smaller companies can't do. So there's hundreds of reasons. There's also the reason that, large investors are willing to pay higher multiples, but they've got more capital. So if they can deploy more capital in one go, they're willing to pay more for it. So that's another reason. There's hundreds of reasons like that why the larger the company, the higher the multiple it can attract. But this is one of the key drivers of especially mid-market private equity, is buying a platform, bolting on smaller acquisitions, particularly at lower multiples, and then expecting a higher multiple at exit as well. So if you can get 8 times because of this bolt-on, you're all of a sudden getting a much significant money multiple on your investment. But obviously there's a lot more complexity to modeling it out. You need to factor in the funding for the bolt-on acquisitions. For example, you're going to fund it with debt or you're going to put in extra equity. So you need to model that out. And when it comes in, it's not going to be day one. It's going to be, might be in like year 2, year 3, year 4, etc. So how are you modeling that in? You also got to factor in what's the impact on P&L, and do you need to separate that out, the 2 P&L, so you've got different growth rate assumptions across the 2. Are there cost synergies that you need to model in, etc. So this is a very simple LBO model. Obviously a full model is going to be very complicated as you need to model out every single assumption. So we're just assuming a single business LBO in this instance. So as I was saying, in a world of increasing interest rates and quantitative tightening, there's less emphasis on just increasing debt in the business, because obviously there's going to be more costs associated with that. And there's less emphasis with just getting multiple arbitrage. So private equity and firms, venture capital firms, investment banks, etc., their mandate is going to be focusing more on how do we drive organic growth and bolt-on acquisition. So we're really going to focus on the organic growth side because obviously bolt-on acquisitions aren't necessarily modeled in here. So we need to really pay close attention to what is the impact of organic growth on the business. And when I say organic growth, I mean this business we've assumed is growing 6% by itself without us doing anything. So is there a way that we can actually cut some costs in here by changing the margin, making it more aggressive? If we were to assume that revenue growth was only 4%, for example, but margins stay the same, our return has dropped from 6.4 to 5.8. So it's not as big of an impact as it was by just changing the upfront acquisition multiple. So let's see what happens when we change revenue to 5%. You can see our money multiples jumping like 0.2 or 0.1 each time. That was 0.1. So you can see it's not making a huge impact, whereas if we change the acquisition multiple to 7, all of a sudden it jumps quite significantly. So that it's multiple arbitrage and debt are one of the key drivers of returns, but you can also get value out of organic growth assumptions as well. Okay, cool. Tax rate is not something that you can really change over time, but some businesses might be able to factor in some tax savings because of some international tax agreement, but for the most case you want to leave this fairly consistent, but obviously that depends on the jurisdiction that you're in. Operating cash conversion, you might have some influence on the business in your ability to drive net working capital movements, but for the most part this is really dependent on the actual company itself and what industry it operates in. So for example, you might just have a tech SaaS business which doesn't really have much working capital at all. It's really just bringing in on the revenue on a monthly basis. There's not much working capital there. Alternatively, you might have a manufacturer of steel products who needs to buy the next 3 months of inventory up front, and then there's this huge cash suck out of the business initially because they got to pay for that inventory before they're actually getting the cash from future sales. So it really depends on the business, but there are some areas where you can potentially assume some improvement in cash conversion, but it means as a private equity firm you need to go in and actually improve that business and make some changes. So, and you're not even going to get much value from it. So if we assume a 1% improvement in operating cash conversion, let's see what happens. We're going from a 3.6 money multiple to a 3.6 money multiple. So it only made about 200k improvement on your outro. So, and realistically, can you make those changes? It's really hard to tell at the initial stages. So my recommendation, probably just keep it as is, but you do need to know what the base position is for what is your operating cash conversion. CapEx, maintenance is also factored in here. Again, really depends on the business. Tax paid flows through, bank interest cost flows through, etc. So really those are kind of the key drivers of value. So it's really how much you're paying for the business up front, how much debt you're putting on the balance sheet of the business, what are your organic growth assumptions essentially. And finally, bolt-on acquisitions is a major driver as well, which we haven't modeled in here, but you could do it a very simple way by assuming certain assumptions around your multiple in and out as a result of it. And that's pretty much it for the key drivers. And I guess another key feature that we do of like Excel modeling to really test out those value drivers is we can actually do sensitivity analysis. And what sensitivity analysis does is, yes, we went through each one and we played through different assumptions manually to see what the impact is. But this is actually a way of creating a table to actually calculate at different rates. So for example, our entry multiple. So let's start preparing this on the right hand side of our model. I'm just going to separate this with a gray bar. We can do a table where we actually just type out each of the acquisition multiples. So let's assume to do 8 times, but what would it be if we did, you know, an entry multiple of 4? All the way up. All the way up to, say, you know, 12 times. And essentially we can show, okay, based on all of the other assumptions staying the same, so interest rate, debt we're putting in, exit assumption, etc., what would our kind of returns be at each of those different levels? So you can quickly see for one variable input what the output would be. And you can even do it for 2 variable inputs. Like you can test 2 at the same time. Like you can test input and exit multiples, or you can test debt and input multiple, or exit multiple and debt level. So you can do all of this, and it's a great way of really representing which are the most sensitive drivers to your model. Okay, so what I've done here is I've basically laid out the table how we want to structure it, and this is essentially a very basic data table for sensitivity analysis. So we want our input variable at the top, right? In this case, the input variable that we want to test is our entry multiple over here. And then we basically put our outputs down below. So what do we want to show? MOIC, which is basically your money multiple, or multiple on invested cost, which is the same as this here, or IRR percentage, which is the same as this percentage here. Over here, you want to leave these blank because this is what the data table is going to fill it with. And basically what you do, and make sure these are all linked to the relevant place. So this is linked into where the input cell should go, and these are linked to the output. So what you want to do is essentially select this data, like so, and go to the data tab, what if analysis, data table. And then basically, I always forget which one is which, but I'm pretty sure it's row input cell because each of these is going across the row. So basically we want to show where the input cell is. I believe we press that one there, which link it to the input cell. So that now we're telling Excel that basically each of these inputs that we've got going across the row, these need to be plugged into this input cell over here. And then the output is whatever we've linked it to over here. It's a little bit confusing, but basically what this is saying is that if we were to get this business at 4 times, our money multiple would be 3.6. Sorry, would be 20.1, and our IRR would be 112%. Conversely, if we bought it at 8 times entry multiple, our money on invested capital would be 3.6 times, which you can see matches with that, and our IRR would be 37.7%, which again matches with this. So this all makes sense, and it's just a really simple way of seeing what one change in one input variable has on the rest of the model without necessarily changing any other component. So you can see that entry multiple is very sensitive to returns. You can see there's a very big discrepancy. So we can copy and paste this and test a few different variables as well. So for example, if we wanted to test exit multiple, debt, and maybe one other, let's do, what should we do? Maybe revenue growth, potentially, or margin. Let's do revenue growth. Entry, exit, debt, multiple, and revenue growth. So let's go ahead and we want to link the relevant input variable. In fact, I don't think you even need this cell up here, to be honest, because we're going to tell Excel which cell to link it to. So probably should have locked these. There we go. Oops. And then for each of these, we want to decide what we want to assume. So we can probably keep this the same for exit multiple. That's fine. For debt multiple, we can assume probably 0 and then +1 for each of these, so that's fine. And then revenue growth, we want percentages. So let's start off with 0% and then add +1% for each of these. Perfect. Okay, cool. So the last step is just to update our data table for all of these. So what we can do is select this, go data, what if data table, and select the input cell. So in this case, we're doing exit multiple. So let's find the exit multiple that we're assuming, which is 8. And now this makes sense, right? Because it's the complete opposite. The lower the exit multiple, the lower the return we're going to get. So this is basically saying if we buy the business at 8 times, because it keeps every other input assumption the same, and we exit at 4 times, we can still get an okay, not a great, but an okay return, simply because we've put debt in up front. So essentially we're really only putting in, we're really only paying a 5 times multiple out of equity for this, and selling it at 4 times. So we're losing 1 multiple on exit, but we're growing the business through revenue growth. We're paying down the debt through cash flow. So yeah, that's basically why it's not as terrible as it seems. But then conversely, if we were to exit at 12 times, we're getting a 5 times money multiple. Debt, maybe you don't want to put as many in this table, but I'll just keep it in there for consistency. Let's repeat the process. So we'll go, what if data table, in this case, the input cell is going to be this number here, because this is our leverage ratio of debt. And as you can see, these numbers are too big. It's actually I'll actually end up deleting these, and then we'll do it again, because obviously if you have 8 times debt, you're basically assuming a higher multiple. You're basically putting no equity in, basically. So let's go, what if data table, row input, this one. So if we were to put 6 times in debt, which is clearly impossible, but if we did, we'd get an enormous return, simply because if we put 6 times debt ratio in, we'd only have to put in $900,000 in capital and $6 million is on debt. Obviously no bank is going to lend you that, but of course that's going to lend you to insane returns on your investment. So let's bring that back to 3. And then revenue growth, same thing. Let's go data table, row input cell revenue, and there we go. So you can see that revenue doesn't have as big of an impact on on your returns, whereas debt has the biggest returns, and then exit and entry have kind of similar range, kind of still very big returns. And that's basically what a sensitivity analysis is. So you can also do this with 2, like you can have another variable down the side. So you can maybe have your entry multiples up here and then exit multiples down here. Select the table like that. And then basically when you do the data table, you select both a row input and a column input, and you can do that if you want. But personally, for me, single variable analysis is fine. And that's pretty much it. That's all there is to know. We'll end the video there. Hopefully you found it useful. Thanks for watching.